Howdy, Jacob here. Today we're looking at a deeper dive on Bloomin Brands. We did this company probably pushing a year ago by now, and it was in my dividend yield stock screener, 15th company I did, reviewed, and we had it looking like now it is a good buy. And so if you can get the type of yield that is under the screener of greater than 4% with a discount rate of 15%, I mean, that's pretty fantastic, especially for someone who's in retirement. They can sit down, get that dividend, and also very likely, given conservative assumptions, get appreciation on the company's stock price through share repurchases and improvement on business. And so, just to remind people about the business itself, this is a hotel, restaurant, leisure industry, 1.1 billion market cap, almost double enterprise value. They operate including Outback Steakhouse, Carrabba's Italian Grill, Bonefish Grill, and Fleming's Prime Steakhouse. And they're headquartered in Tampa, Florida, founded in 1988. Their revenue growth got hit pretty bad from COVID, but again, the last 3 years, they've found ways to grow. And gross margin, not very impressive, 16, 17, 18%. Operating margin, again, not crazy impressive, of 7 to 8%. They pay a dividend. It hasn't been a long history of dividends, so it's not like some of the other businesses that have grown 1 or 2% in their dividend for a long period of time. But we do see a 96-cent dividend on 7% yield. And so we have a massive yield on this dividend, and it looks to be a reasonable payout of their most recent couple years of earnings per share and a most recent of their free cash flow, 80 million in relation to almost 200 million over here. And so let's go over some of the notes I took from reading some quarterly reports as well as their most recent 10K. So they franchise, like I said, out of Outback Steakhouse, Carrabba's Italian Grill, Bonefish Grill, and Fleming's Prime Steakhouse and Wine Bar. They are a restaurant level operating margin. Their restaurant level operating margin sways around 15% in 2023, and it is down to about 12.5% in the most recent quarter. And so margins are definitely being hit recently. But a restaurant level operating margin of 15% is pretty good. But again, down to 12.5% most recent quarter. Revenue in the most recent quarter is also dampened, down 3.8% year over year. Share repurchase program has $96 million in 2024. That is going to be slightly less than 10% of their shares outstanding. And so they do still have a good amount of opportunity to buy back shares if they are willing to do that. And if their management agrees on it, or their board does. On November 6, 2024, Bloomin entered into a strategic partnership with Vinci Partners to sell 2/3 of their Brazil operations for roughly $243 million. This includes a royalty stream with options to sell their entire stake in 2028. They own and operate 1189 restaurants, franchise 291 restaurants. Outback is the majority of their franchises and restaurants, with 688 stores, restaurants in the US and 330 internationally. So a heavy amount of the restaurants operated and franchised are going to be their Outback Steakhouse, which is going to be their more casual option of eating out. Their net reduction of 13 restaurants in the US and 22 increase internationally. And so reduced restaurants 13 in the US, increased at 22 internationally. So they are still growing the number of stores, number of restaurants internationally, but they are hopefully taking away the inefficient restaurants and keeping the ones that are still producing very heavy margins. That is something that is a very advantageous thing to do for companies with leases. So you're either your classic, Walmart makes money in a lot of places, but Five Below, a Walmart, an Ulta, or even restaurants like a McDonald's, or in this case, your Outback Steakhouse, Carrabba's, Bonefish Grill, and Fleming's. they're hopefully decreasing the number of stores that are inefficient and only focusing on places that they really think they can get a lot of traffic and get a lot of money for those stores, good return on their invested capital. So about 95% of their beef is sourced from 4 suppliers, and 80% of their pork in Brazil is from 4 suppliers. So this is just saying, there are some risks if one of those suppliers goes out, they have an outbreak of some disease with their animals that, is the Outback Steakhouse and their products that would affect them, and they likely would either have to pay a lot more from a different supplier or um, find themselves in a inability to meet demand for their product. But those are the pretty 4 common suppliers around, so I'm not terribly concerned by it. So 4 business strategies for 2024, pretty basic, but enhance the customer experience to drive sustainable, healthy sales growth, drive long-term shareholder value, enrich engagement among stakeholders, and accelerate growth opportunities. I mean, it's very vague, but that's just what their, I believe, 10K said. Comparable restaurant sales of Outback, 2.8% in 2022, 1.1% in 2023. Carrabba's was 3.4% increase in revenue in 2022, 3.9% in 2023. Bonefish, 4.5% in 2022, 0.8% in 2023. Fleming's was 12% increase year over year in 2022 and down a little bit in 2023, with their international growing 38% in 2022 and 5% in 2023. So what I see from this is that I do like that they're still increasing the number of stores internationally, given the fact that comparable store sales restaurant sales is going up internationally. So this combines U.S. traffic of minus 5% in 2022 and minus 3% in 2023. So although the bills are higher because of likely inflation, they cost more, so they're able to sell for more, the traffic's actually down. That's something to keep in mind for sure. International operating margin of 20.5% in 2023 versus the U.S. operating margin of 15.4%. Do you like also that operating margin is higher on the international side? That's growing more and is showing positive. They're putting down more stores. They have debt of 105 mil due in May of 25, 381 mil due in April of 26, and 300 mil due in April of 2029. Their free cash flow allocation for 2021 to 2023 was about 41% to debt, reducing debt, 20% to their dividend, 27% to share repurchases. This includes 2021, where capital was being spent nearly entirely on debt reduction with zero allocation of dividends or share purchases. So again, due to COVID, they removed their dividend. They didn't buy back any shares, and they just reduced a bunch of debt. And let's see if we see that here. So, yep, this is their 2021. They made $289 million, and they spent $298 million in debt reduction. Since then, they have balanced out share purchases with the dividend. But they do still have a good amount of debt on hand, which we see from, although it's down from $1 billion to less than $800 million, they still do have long-term debt. And so, again, like most restaurants, not terribly concerned with those capital leases. And the debt that they have, I think, is possible to either repay or get a new interest rate. Not terribly concerned by that. So off my initial assumptions, I think what I would do is bring this down to about 2%. I don't mind these margins. I just dampen the free cash flow margin a tad. I think buying back 1% of shares is pretty reasonable to me because majority of that capital allocation is going to be going towards a dividend, but 1% is still very reasonable. I increased it to a 16% return given the fact that they do have a good amount of debt, and in relation to their market cap, I mean, their enterprise value is almost double. And 10 on the P for the same reason. And if I do this with a dividend that I might just keep the same, actually, due to the fact that it hasn't really been around for a while this large, it needs to fall 20%. But for a dividend company paying out 7% yield to get this type of return is very impressive. And so this could be something that you look into. Hope you enjoy the video.